Picture this: September 15th, 2008. The world watches in disbelief as employees of a 158-year-old banking giant, Lehman Brothers, walk out of their offices with cardboard boxes in hand. This wasn't just a company going bankrupt. It was the domino that triggered the worst global financial crisis since the Great Depression. So, how did a powerhouse of Wall Street, a name synonymous with financial might, simply vanish overnight? Let's unravel the story of the collapse of Lehman Brothers. To understand this financial earthquake, we need to go back to the early 2000s. The American dream was alive and well, and at its heart was home ownership. Interest rates were low, making it cheaper than ever to borrow money. Banks were practically handing out mortgages, even to people with shaky credit histories. These were called subprime mortgages. It seemed like a win-win. People got their dream homes, and banks made a fortune selling these loans. Now, where does Lehman Brothers fit into all of this? Like other investment banks, Lehman didn't just hold onto these mortgages. That would be too slow. Instead, they bundled thousands of them together into complex financial products called mortgage-backed securities, or MBS. Think of it like a fruit salad. You take a bunch of different fruits, some good, some maybe a little bruised, and mix them all together. You then slice this salad up and sell it to investors all over the world. These MBS products were then sold to investors, pension funds, other banks, even foreign governments. The promise was a steady stream of income from all the homeowners paying their monthly mortgages. And to make these products seem even safer, credit rating agencies stamped them with a AAA rating, the highest possible grade. This was like putting a certified fresh sticker on the fruit salad, even if some of the fruit was starting to rot. Lehman Brothers dived headfirst into this market. They weren't just selling these securities, they were buying them, investing heavily in the real estate market, and taking on massive amounts of debt to finance it all. This is where a key term comes in: leverage. Leverage is like using a small amount of your own money and a huge amount of borrowed money to make a big bet. If the bet pays off, you make a massive profit. But if it goes wrong, your losses are amplified. At its peak, Lehman was leveraged over 30 to 1. That means for every $1 of their own capital, they were borrowing and investing more than $30. It was a high-wire act with no safety net. For a while, the party was roaring. Housing prices just kept going up and up. It felt like a sure thing. If a homeowner couldn't pay their mortgage, the bank could just foreclose on the house and sell it for a profit because its value had increased. What could possibly go wrong? Well, starting in 2006 and 2007, the what could go wrong started to happen. The Federal Reserve began raising interest rates to combat inflation. Suddenly, those adjustable-rate subprime mortgages became a lot more expensive for homeowners. Payments ballooned, and people started defaulting on their loans in record numbers. The housing bubble, which everyone thought was invincible, began to pop. As homeowners defaulted, the houses that banks foreclosed on flooded the market. With so much supply and falling demand, housing prices plummeted. Remember that fruit salad, the mortgage-backed securities? Suddenly, the rotten fruit, the subprime mortgages, was contaminating the entire bowl. The steady stream of income that investors were promised dried up. Panic set in. These MBS products, once considered as safe as gold, became toxic waste. No one wanted to buy them. In fact, no one even knew what they were worth anymore because they were so complex. The market for them completely froze. This is where Lehman Brothers' high-wire act came crashing down. The billions of dollars of mortgage-backed securities on their books were now practically worthless. Their massive leverage turned against them. The value of their assets was collapsing, but their enormous debts remained. It was a recipe for disaster. Confidence, the very lifeblood of the banking system, evaporated. Other banks, fearing that Lehman was on the brink of collapse, stopped lending to them. Lehman was running out of cash, and fast. Throughout the summer of 2008, a frantic scramble to save Lehman was underway. They tried to sell off parts of their business and find a buyer. The US government, led by Treasury Secretary Henry Paulson, and the Federal Reserve, led by Ben Bernanke, tried to broker a deal. Talks were held with Bank of America and the British bank Barclays. But no one wanted to take on Lehman's mountain of toxic assets without government help. This brings us to that fateful weekend in September. The government had already bailed out another investment bank, Bear Stearns, just 6 months earlier, and had just taken over the mortgage giants Fannie Mae and Freddie Mac. There was a sense of bailout fatigue and a growing public anger against Wall Street. The government made a critical decision. There would be no public money to save Lehman Brothers. The message was clear. Wall Street had to face the consequences of its own reckless behavior. Without a buyer and without a government bailout, Lehman had no options left. In the early hours of Monday, September 15, 2008, Lehman Brothers Holdings Incorporated filed for Chapter 11 bankruptcy. It was the largest bankruptcy filing in U.S. history, with over $600 billion in assets. The collapse sent shockwaves through the global financial system. It was no longer just a Wall Street problem. It was a Main Street crisis. The intricate web of connections between financial institutions meant that Lehman's failure created a domino effect. A major money market fund broke the buck, meaning its value fell below $1 per share, causing a massive panic among everyday investors. Credit markets froze solid. Banks stopped lending to each other, to businesses, and to individuals. The global economy ground to a halt. The Dow Jones Industrial Average plummeted. People's retirement savings were wiped out. Businesses couldn't get loans to make payroll. Layoffs swept across the country and the world. The Great Recession had begun. In the aftermath, governments and central banks around the world were forced to take unprecedented action to prevent a total collapse. They injected trillions of dollars into the banking system, bailed out other failing institutions like the insurance giant AIG, and slashed interest rates to near zero. The crisis led to sweeping new regulations, like the Dodd-Frank Act in the US, designed to increase transparency and prevent banks from taking on the same kind of excessive risk. The story of Lehman Brothers is more than just a business failure. It's a cautionary tale about greed, complexity, and the dangers of unchecked risk. It shows how interconnected our global financial system is and how quickly confidence can shatter. The decisions made in the gleaming towers of Wall Street had a profound and painful impact on the lives of millions of people around the globe, an impact that is still felt to this day. It serves as a stark reminder that when the music stops, someone always has to pay the price. Thanks for watching. If you found this video insightful, please hit that like button and subscribe to our channel for more deep dives into the events that shaped our world. See you in the next one.